What's up, guys? Today we're going to do Unit 4, which is the financial sector, topic 4.6, which is monetary policy. In this video, we're going to talk about expansionary and contractionary policy, open market operations and the discount rate, the federal funds rate, and then time lags. Okay, so let's go ahead and get started. All right, so the Federal Reserve has three tools that it can use. It can use to fix the economy, right? Or to, by fix the economy, by either contract the economy or expand the economy. And it can use the reserve ratios, it can use the discount rate, and then it can use open market operations. And so we'll look at those here shortly. So first, the reserve requirement or the reserve ratio is the ratio that is set by the Fed that banks have to follow, right? And so that is the money that the banks have to hold on to and cannot lend out, right? Only a small portion of your money is held in the reserve, right? The rest of that money is lent out, and that is called fractional reserve banking. So the Fed sets the amount banks must hold, right? And the reserve requirement is the reserve ratio is the percentage of deposits the bank must hold in the reserves to prevent the percent that cannot be lent out, right? And so that leads to, again, fractional reserve banking, or a multiplier effect on your money. So when you go to the bank and you deposit $100, $10 is set aside if the reserve ratio is 10%. $10 is set aside in the vault, right? Cannot be touched. It has to be held in the bank. That other $90 goes to excess reserves that can be lent out or used to buy T-bonds or something else by the bank. Okay. All right. Now. So how the reserve requirements used for different parts when we're in different parts of the economy, right? So let's say that we see a business cycle, right? Or a peak or a trough, right? So if we're at a peak, what's going to happen to the reserve requirements? Well, the banks want us to stop spending as much, right? I'm sorry, the Federal Reserve wants to cool off the economy. They want the consumers and investment to not spend as much. So what they will do is they will raise the they will raise the reserve ratio, making banks hold on to more money in the vault, right, or in that they cannot spend, right, or lend out. So they will increase the reserve ratio. Now, if we're in a trough, right, and we want to get out of that trough, what the Federal Reserve could do is they could decrease the reserve requirement, giving more money out or making loans easier for people to make, because now we have more supply of money, right? So now we can, or the banks have more supply, so then they can make more loans out, right? They won't be capped out at a certain amount. And so thus making it easier to make loans is probably going to lower the interest rates as well. So in a trough, again, the reserve requirement would be lowered, right? In a peak, the reserve requirement would be raised, right? And just on a side note, the reserve requirement's hardly ever moved, right? I think right now it's at 10%. They talked about, during the COVID pandemic, they talked about moving that, right, lowering it, but I don't think they've done that. And it's just one of the tools that they can do, but it's it's not used very often. Okay, the next tool that the Federal Reserve can use is the discount rate, and the discount rate is the interest rate that the Fed charges commercial banks, right? Keep in mind that banks have to, at the end of the day, they have to balance out, right? So sometimes banks will need to go to the Federal Reserve and use the discount rate to take out a loan, right? And so that's the interest rates that banks charge, or that the Federal Reserve charges specifically to banks, right? And then we have something called open market operations, and this is very commonly used, all right? And so open market operations is the Fed buys or sells government bonds or securities, right? And so this is the most important and widely used monetary policy. So how does it work? Well, let's think about this. If we want more money out in the economy, right, and I'm the Federal Reserve, and I have all this money right here, right, and I want money out in circulation. Well, if someone comes in and they want to sell me a bond, right, I'm going to give them money, right? So sell is going to I'm going to buy, right? I'm buying their bonds. They're coming to sell me. The individual's coming to sell me the bond. I'm the Federal Reserve buying the bond. So if I buy the bond and I give them money, that's going to increase the money supply out in society, right? So buy big, right? That old saying, buy big, sell small. That we're going to use that here, right? And that when you buy bonds, you're making the money supply bigger, right? Because you're putting that money out into circulation. Now, let's say that I'm selling bonds, right? So now I have, a stack of bonds, right? And you come in with your money, right? And I give you a bond, and you're giving me cash. Well, I'm the Federal Reserve. I put it over here in the vault, right? And so now I'm shrinking the money supply curve, right? Or the money supply by holding on to and taking that money out of circulation. So again, this is very widely used. New York is is where they do this, the open market operations, or the Federal Reserve building in New York. But buy big, sell small, a good way to remember that. Now, there's also something called the federal funds rate, and the federal funds rate is the interest rates that banks charge to one another for one-day loans of reserves, right? And so, the Federal Reserve simply can't tell banks what interest rate to use. So banks decide on their own, right? And the Fed influences them by setting a target rate and using an open market operations to hit the target rate. So the federal funds rate fluctuates due to the market conditions, right? And but it's heavily influenced by monetary policy, the buying and selling of bonds. Now, let's go ahead and look at, just a few examples of using monetary policy and how that's going to affect GDP. All right. So if we were to, let's say, increase, the Federal Reserve wanted to use one of their tools, right, to increase the money supply curve, right? So what's happened to interest rates here if they've increased the money supply curve, right? Well, what's happened is interest rates have fallen, right? Well, if interest rates fall, right, what's going to happen to investment? Well, if interest rates fall, right, investment goes up. So if investment goes up and we look at an ADAS model, right, we could see that, again, investment increases. That would shift AD closing the gap. So if we're in a recession, the Federal Reserve, what they're going to want to do is they're going to somehow use one of the three tools to push money supply to the right or increase our money supply. Lowering interest rates. By lowering interest rates, that lowers the interest rates on loans, right? So consumers and investment, right, both, who take out loans. Like we take out loans for cars, we take out loans for houses, stuff like that. Businesses, they take out much bigger loans, right? So they're going to impact or have a bigger impact on GDP than consumers, right? But with loans, but that's going to push our AD to the right, increasing aggregate demand, getting us out of the recession, right? And so if we were to do the opposite, right? Let's say that the Federal Reserve decides that they're going to sell bonds, right? Well, if they're going to sell bonds, right, and let's say that we're in an inflationary period, right? That looks like this right here. We're in an inflationary period. Then the Federal Reserve decides that they're going to sell bonds. By selling bonds, they increase the interest rate. By increasing the interest rate, it's going to make it harder or it's going to be more expensive to take out loans. So by doing that, you're going to then push your AD curve to the, let's do this right, your AD curve to the left, decreasing aggregate demand, and getting you out of that inflationary gap, right? And so those are the two things that the Federal Reserve can do and using those three tools is increasing the money supply or decreasing the money supply. All right, so that is going to be it for us today. Thank you guys and have a good one. See ya.